This is INBrief with Chloe Berry, Managing Partner Infrastructure at Brookfield. Chloe, it's a great pleasure to have you here in Noosa, all the way from Toronto. I believe you've been in Australia for about 90 minutes as we speak. Welcome.
Not even, I don't think, but thank you, James. So excited to be here and speaking to you today.
Chloe, infrastructure is being pulled by some very, very powerful long-term trends at the moment, but in which parts of the asset class are you seeing the most really exciting opportunities?
James, it's a great question, but infrastructure is just so exciting right now, and it is touching actually everything. Um, we at Brookfield have tried to distill it down into a kind of digestible term. We call it the 3Ds, where we're seeing the most impact from trends and kind of exciting investment opportunities right now. The first being digitalization, deglobalization, and decarbonization. So those are 3Ds that we've kind of simplified for an audience to understand where we're seeing the trends. What those really mean is on the digitalization side, this is an obvious one with data centers and the AI trends, but it's really everything from upgrading copper networks to fiber, to building out our telecom tower networks, building out data centers. On decarbonization, that is the additionality of new renewable power, wind, solar, hydro, but it's really a lot more than that. It's building transmission lines from that new renewable power source to the grids, and it's converting our traditional pipelines to potentially take hydrogen and things like that. And then on the deglobalization side, this is a trend that most people think is relatively recent, but it's been going for a decade or two, and this is the onshoring of critical resources, now really the onshoring of manufacturing in general, as well as energy security, which is very topical right now, and supply chain reinforcement. And so those three trends are really impacting every sector in infrastructure right now, creating an immense amount of deployment opportunity.
And in which assets or subsectors, Chloe, do you feel the 3Ds will make themselves apparent to investors and be really compelling for investors soonest?
If we think about where we invest in infrastructure, and at Brookfield, we are a relatively traditional, or I would say we have a relatively conservative definition of infrastructure. We invest across your typical utilities, pipelines, so midstream assets, renewable power and transition assets, digitalization assets, and transportation. And so if I think about the 3Ds that we spoke about, they do impact all five sectors. Again, when we think about digitalization and data assets, that's kind of an obvious one. We are seeing an immense amount to do with AI infrastructure. And even, before that, cloud build out and the amount that's going into data centers. But what's really interesting with that is the evolution of how these subsectors are evolving. So, if we think about in the 1900s, where infrastructure didn't really exist, and it was the mining companies who had the ports and the rail, or the pulp and paper who had the hydro mills, and the mining companies sold off the ports and the rails to infrastructure asset owners, and that became pure play infrastructure. The same thing is happening in digital infrastructure right now. So the big hyperscalers, the Googles, the Metas, the Amazons of the world, they don't need to own their data centers, so they're selling them off to the likes of the Brookfield infrastructures of the world. The same with tower companies. Big mobile network operators are realizing that they're not the best equipped to operate these assets, and they can be much more efficient if they sell them to pure play infrastructure assets that are going to give them the time, the attention, and the capital they need. And these businesses can take that money from the sale of these assets and reinvest it in their core business. And so we're seeing the evolution of these industries into what we would call pure play infrastructure assets. And that's just really opening up the world in what we can invest in, all with the same underlying characteristics of infrastructure. And just as a reminder, as we haven't touched on it, those are things like long-term contracted and regulated assets, inflation protection, downside protection, really looking for those stable, predictable returns and those stable, predictable assets.
At the Investment Leaders Forum, Noosa, Chloe, you're addressing an audience of advisors and asset consultants. So from that point of view of an advisor who's thinking about building resilient portfolios, what role can infrastructure and should infrastructure play now that income and diversification matter more again?
Yeah, so it's a great question and leads on to what I was just talking about a little bit on the characteristics of infrastructure and what we really look at when we're investing. And so, um, infrastructure, again, we're looking for that very stable, predictable asset class. We want stable, predictable cash flows, means stable, predictable income, but also return generation. And so when we look at how an infrastructure asset or a fund, infrastructure fund, can fit in an investor's portfolio, it has an element of operational income, of cash distribution, but it also has an element of growth that could be from inflation linkage. So your revenues increasing by your local CPI, modest growth projects, GDP growth, things like that. And so you're really looking for that operating income with modest capital appreciation over time. And so when you think about an asset class like that, it's some people look at it as a bit of an fixed income replacement because it's got that income allocation, but also some of your lower risk equities allocation because of that capital appreciation. And so it's not a great answer because people tend to take a little bit from both. We really believe infrastructure should be a core asset class in its own right. And just that cornerstone in a portfolio that provides this stability that investors want, especially in what are very, very volatile times. And when you're looking at an infrastructure asset with that downside protection, that sort of modest capital appreciation, it's really defensive in your portfolio. It has very low correlation to other asset classes because when markets are up, infrastructure tends to tick along. But when markets are down, it still tends to tick along and have positive returns. And so infrastructure is that asset class you want to give you that resilience in your portfolio throughout market cycles.
Infrastructure is a very long-term asset class, Chloe. So how has your approach to infrastructure investing evolved through different market and economic cycles?
James, it's a great question. Brookfield, if I think about our history, we've been around for 125 years. In fact, our origins are infrastructure. Back in the 1890s in Brazil, where we owned hydro generation, electricity transmission, and tramway systems, really serving or providing 2/3 of the Brazil population with their power. Over the next 125 years, we've owned infrastructure on our own balance sheet in a number of ways. Owning and operating infrastructure on our own balance sheet before raising third-party capital. What I'd say is infrastructure really is an asset class for all market cycles, and our approach hasn't changed. The underlying characteristics we look for, the underlying downside protection, that inflation linkage, putting in place conservative, long-term fixed rate capital structures, all of that has stayed the same. Um, what has changed a little bit, as I touched on earlier, is the evolution of infrastructure through, bringing in, for I guess from your traditional kind of utilities and midstream and transportation assets to renewable power, transition, and then more recently, digital infrastructure. And so we still, as that industry or as those industries evolve, we're still looking for the same characteristics, the same qualities of infrastructure, and we are uncompromising in that. It's just that the universe of investment opportunities is changing. But as we invest today, it should be able to be done through market cycles, through macroeconomic cycles, and be an asset class that can really be that cornerstone in an individual's portfolio.
Chloe Berry, Managing Partner Infrastructure at Brookfield. Again, welcome to Noosa and thank you for your time today.
Thank you.